If you opened your 401k app right now and saw a fund with the year 2060 in the name, you probably thought, perfect, that's my retirement year. This fund knows what it's doing. But here's what nobody told you. That fund, the one designed for someone retiring decades from now, already has roughly 10% of your money sitting in bonds. At 26, you might be thinking, 10%, that's not a big deal. But by the time you hit 60, that seemingly innocent allocation could trim around $190,000 from your balance. $190,000, gone. Not from a crash, not from fees, but from a default setting that most people never even look at. Now, before I break down exactly how this happens and what to do about it, I need to show you how target date funds actually work behind the scenes, because the mechanics matter more than you think. Okay, so target date funds were created as a set-it-and-forget-it solution. The idea is simple. You pick the year you plan to retire, say 2060, and the fund automatically adjusts its risk level as you get closer to that date. When you're young, the fund is mostly stocks. As you age, it gradually shifts more money into bonds. This gradual shift has a name. It's called the glide path. Sounds smart, right? And conceptually it is. The problem is in the execution. See, most major target date funds don't start at 100% stocks. They start at around 90% stocks and 10% bonds. Even for someone who is 25, 30, 35 years away from retirement. Vanguard's 2060 fund, one of the most popular in the country, holds about 10% in bonds right now. Fidelity's 2060 fund, similar story. T. Rowe Price 2060, same thing. These are the default options in millions of workplace retirement plans. When you got hired, your company probably enrolled you automatically into one of these. And if you never touched it, you're sitting in that default right now. Now let's talk about why that 10% matters so much. Over a 30-plus year time horizon, stocks have historically returned about 10% annually. Bonds, over that same period, return closer to 4 or 5%. So when the fund puts 10% of your money in bonds instead of stocks, it's not just sitting there safely. It's actively dragging down your long-term returns. Let me show you with real numbers. Let's say you're 26, you have $50,000 in your 401k right now, and you contribute $10,000 a year. That's about $833 a month, very realistic for a millennial who's been working a few years. If all of that money stayed in stocks returning 10%, by age 60, you'd have roughly $2.1 million. But with 10% consistently in bonds dragging your average return down to about 9.4%, your balance drops to roughly $1.91 million. That's nearly $190,000 left on the table. Not over 34 years of bad decisions. Over 34 years of doing exactly what you were told. And here's the part that really stings. The glide path doesn't stay at 10% bonds. It increases. Every year, as you get closer to the target date, the fund automatically shifts even more into bonds. By the time you're 50, your fund might be holding 20 or 25% in bonds. By 60, it could be 40 or 50%. Now, some of that shift makes sense as you near retirement. You don't want a market crash wiping you out the year before you stop working. But the question is whether the timeline and the aggressiveness of that shift actually matches your situation. For a lot of millennials, it doesn't. Here's why. Most millennials aren't going to retire at 60. We're starting careers later, we've got student loans, we're buying houses later, and many of us plan to work into our late 60s or 70s. If you retire at 65 or 70, but your target date fund is built around a 60 assumption, it's going conservative too early. And conservative means lower returns during years when you need growth the most. There's also a bigger philosophical question here. A target date fund's entire strategy is built on the idea that you'll pull all your money out at retirement. But that's not how most people actually retire. Most people withdraw a little bit each year. The bulk of your money stays invested for decades after you retire. So going heavy into bonds at 60 actually works against you if you end up living to 85 or 90. Okay, so what do you actually do about this? Option 1, and the simplest, is to just pick a later target date fund. If you plan to retire around 2055, choose the 2065 fund instead. This keeps you in a higher stock allocation for longer, which matches a longer working and investing horizon. A lot of people don't know this, but nothing says you have to pick the fund with your actual retirement year. It's just a label. Option 2. If your 401k plan allows it, skip the target date fund entirely and build your own mix. Something like a total stock market index fund or an S&P 500 fund at 100% until you're within 10 or 15 years of retirement. Then you can start adding bonds on your own terms based on your actual risk tolerance and financial situation, not a one-size-fits-all formula. Option 3, and this is for people who want maximum simplicity, stay in a target date fund, but just understand the trade-off. You're paying for convenience with lower returns. That's not the worst thing in the world if it keeps you invested and prevents panic selling. But you should go in with your eyes open. The point of this isn't to scare you or make you think your 401k is broken. It's to make you aware that defaults are just defaults. They're starting points, not strategies. Log into your account. Look at what you're actually holding. Check the bond percentage, and ask yourself if that number makes sense for someone your age with your specific goals. 5 minutes of clicking today could literally be worth 6 figures over your lifetime. If this was helpful, there's more on the channel about investing basics, retirement strategy, and money mistakes that quietly cost you. No fluff, just the stuff that actually moves the needle.